Hey everyone, welcome back to Corporate Decoder. Today, MHK just filed a significant credit agreement, and I am seeing a refinancing that signals a shift in their borrowing strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. Mohawk Industries is essentially changing how it borrows money and by how much, and this move could impact its future flexibility. Alright, let's dive into this filing from Mohawk Industries Incorporated. This is an 8K report, which essentially means something important and timely happened that the company needs to tell the public right away. What happened? Well, on May 12, 2026, Mohawk Industries, which we know as MHK, entered into a brand new credit agreement. Think of this as taking out a new loan or arranging a new line of credit, but on a much larger scale for a company like this. This new agreement is a major event, and it happened on May 12, 2026. It is for Mohawk Industries Incorporated. We know a bit about them from the research context, a company with nearly 40,500 employees and a market cap around $5.9 billion. They are in the consumer cyclical space, specifically furnishings, fixtures, and appliances. They are incorporated in Delaware, a common place for companies to set up their legal structure, and their file number is 01-13697, and their IRS employer identification number is 52 to 1,604,305. Their main office is in Calhoun, Georgia, and you can reach them at 706-629 to 7,721. Their common stock is traded on the New York Stock Exchange under the ticker symbol MHK. The company is not an emerging growth company, meaning it is beyond that initial startup phase. So the big news here is under item 1.01, which is about entering into a material definitive agreement. This new credit agreement is a big deal. What this filing says is that on May 12, 2026, the company Mohawk Industries signed this new credit agreement. Crucially, at the same time, they also paid off and ended their old credit line, the second amended and restated credit agreement from October 2019. They refinanced, basically replacing the old loan with a new, presumably better one. This new deal is a big one. It provides for unsecured revolving credit commitments, meaning it is a line of credit they can draw from as needed, up to a massive initial amount of $1.5 billion. This is a significant amount of capital available. This facility includes regular revolving loans, a sublimit of $125 million for letters of credit, which are basically guarantees for certain transactions, and $150 million for swingline loans, which are short-term loans. And here is an interesting part, it has an accordion feature. This means they can ask to increase the borrowing limit by an additional $600 million. This gives them a lot of flexibility to potentially borrow even more if their business needs it, up to a total of $2.1 billion if they max out that feature. So why did they do this? The money from this new facility will be used to pay off the old loan, cover the costs associated with setting up this new deal, and importantly to fund their everyday operations like managing inventory and covering short-term expenses, essentially working capital and for other general company needs. This new credit line is set to mature on May 12, 2031. That is a 5-year term from 2026 to 2031. But here is a key detail. Mohawk has the option to extend the maturity date up to 2 times, and each extension can be for up to 5 years. This means they could potentially push the final repayment date out much further, maybe even to 2041 if they fully utilize these options. This shows they are aiming for long-term financial stability and planning, and for flexibility, they can pay off this new loan early at any time without any penalty other than covering any immediate costs related to breaking the agreement, like currency exchange settlements. This is a good sign. It means they don't want to be locked into high interest payments if rates fall or their cash flow improves significantly. This credit facility isn't just in US dollars. It is also available in other major currencies like Australian dollars, Canadian dollars, euros, and sterling. This international flexibility is important for a company that likely operates globally. Now let's talk about interest rates for US dollar loans. They have 2 main options. One is based on term SOFR, which is a benchmark interest rate plus a margin that can range from 0.75% to 1.25%. The other is based on a base rate, which is usually tied to the prime rate banks offer their best customers, plus a lower margin of 0% to 0.25%. The company gets to choose which rate to use, which gives them some control over their borrowing costs depending on market conditions. For borrowings in Australian dollars, Canadian dollars, and euros, the interest will be based on the euro currency rate plus a margin of 0.75% to 1.25%. And for sterling, it is based on something called Daily Simple RFR, also with a margin of 0.75% to 1.25%. On top of interest, there is a commitment fee. This is a fee paid to the lenders just for having the money available. Even if Mohawk doesn't borrow it, this fee ranges from a very small 0.05% up to 0.150% per year. These interest rates and fees aren't fixed. They depend on Mohawk's financial health, specifically their consolidated net leverage ratio, which is basically how much debt they have compared to their earnings or their credit rating. If their ratio is good or their credit rating is high, they get lower rates and fees. If their financial situation weakens, the rates and fees go up. This is called a pricing grid, and it is a common way for lenders to manage risk. A very important detail here is that these new credit obligations are unsecured. This means there is no specific company asset tied directly to the loan. This is actually a good sign for the company, as it means they retain more flexibility with their assets. Lenders are willing to do this for companies with strong creditworthiness. The filing also mentions guarantees. This means that if a subsidiary borrower defaults, the other domestic and foreign subsidiaries, along with the parent company, are on the hook to cover those debts. It is a way to spread the risk among the different parts of the company. Like most large loans, this new agreement comes with covenants. These are rules the company must follow. They include restrictions on taking on more debt, pledging assets as collateral, making major changes to the business, and even changing the type of business they are in. These are standard financial controls to protect the lenders. A specific covenant mentioned is that Mohawk must maintain a consolidated interest coverage ratio of at least 3.50 to 1.0. This means their earnings before interest and taxes must be at least 3.5 times greater than their interest expenses. This is a crucial metric showing their ability to comfortably pay the interest on their debts. As of the research context, their P/E ratio is 14.5, which gives a rough idea of their earnings power. But this covenant is a much more direct measure for debt servicing. The agreement also includes standard clauses about making sure the information provided is accurate, and it lists what situations would be considered an event of default, which could trigger penalties or repayment demands. There are also typically grace periods built in for some of these. If a default happens, the lenders, through the administrative agent, can take serious actions. They can stop making new loans, cancel the entire credit line, and demand immediate repayment of all outstanding amounts. This is just a summary, of course. The full details are in the actual credit agreement, filed as Exhibit 10.1. This whole event is also classified under Item 2.03, which deals with creating new financial obligations. So it's pretty straightforward that this filing is all about the company taking on this new debt facility. And finally, Item 9.01 lists the exhibits filed with the report. The most important exhibit here is 10.1, the actual credit agreement. This is where all the nitty-gritty details are. We see that JP Morgan Chase Bank and JP Morgan SA are acting as administrative agents for this deal. This is significant as JP Morgan is a major player in global finance, and their involvement lends credibility to the agreement. And there is the standard interactive data file for the cover page. The filing is signed by R. David Patton, Vice President, Business Strategy and General Counsel, and dated May 13, 2026, just one day after the agreement was executed. So, what does this all mean for Mohawk Industries MHK? This refinancing seems like a strategic move. Securing a $1.5 billion unsecured credit facility with options to expand and extend maturity shows they are positioning themselves for stability and potential growth. The unsecured nature is a strong indicator of lender confidence in the company's financial health. The flexibility in currencies and interest rate options also suggests a sophisticated approach to treasury management compared to their peers. Recent news from May 2026 shows mixed sentiment. Some headlines indicate their stock is underperforming competitors, and that options markets are predicting volatility. However, institutional investors like BlackRock and Vanguard hold significant stakes, showing continued confidence from major players. The fact that they are replacing an existing credit facility with a larger, potentially more advantageous one indicates proactive financial management. This new facility provides them significant liquidity and operational flexibility for years to come. My biggest concern is that while the borrowing capacity is huge, the company's ability to service this debt depends heavily on its future earnings, especially with the required interest coverage ratio. We'll be watching if that leverage ratio stays healthy. The company is also making a lot of moves that seem to be setting them up for future expansion or perhaps larger acquisitions given the scale of this credit line and the accordion feature. It looks like a strong move for long-term financial stability. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.